Hello and welcome back to the Financial Maestro. In this video, we'll demystify stock prices, what they are, and why they change so much. A stock price is essentially the cost of owning one share of a company. It's like a ticket to being part owner of that business. But why does this price change daily? The simplest explanation is demand and supply. If more people want to buy a stock, the demand increases, and so does the price. On the other hand, if people start selling, the supply increases, causing the price to drop. But there's more to it. Stock prices are also influenced by the company's performance. Positive news, like higher profits or a great product launch, often boosts prices. Conversely, bad news, like scandals or losses, can drag prices down. Then there's market sentiment. Investors are humans, after all. News about inflation, political events, or global markets can spark emotions, causing stock prices to react. Lastly, let's touch on market capitalization, the total value of a company's shares. It's calculated by multiplying the stock price by the number of shares. This determines whether a company is small cap, mid cap, or large cap. Understanding stock prices is key to making smart investments. Keep watching for more insights. Chapter 2: Risks and Rewards of Investing in Stocks. Now we'll talk about the risks and rewards of investing in stocks. Let's start with the exciting part, the rewards. Stocks offer capital gains, meaning you can buy a stock at a lower price and sell it higher, making a profit. Some companies even share their profits through dividends, which are regular payments to shareholders. Investing in stocks also means owning part of a company, so you benefit when it grows. But where there's reward, there's also risk. One big risk is market volatility. Stock prices can fall due to economic crises or negative market sentiment. Then there's economic risk, where factors like inflation or interest rates impact your investments. Finally, you face company-specific risks. If the business performs poorly, its stock value may crash. So how do you manage these risks? The answer is diversification. Spread your investments across different stocks and sectors to reduce the impact of a single loss. In summary, stocks are a balance of risk and reward. Invest wisely and stay focused on the long term. Keep watching for more financial wisdom. Now let's move to the last topic, introduction to stock market indicators and how they guide your investments. Indicators are like a report card for the market. They measure how groups of stocks perform and provide insights into trends. Examples include the S&P 500, Nifty 50, and Dow Jones. Let's look at two common terms. A bull market means stock prices are rising steadily, reflecting optimism. A bear market means prices are falling, indicating caution or pessimism. Indicators also include metrics like the price-to-earnings ratio, PE, which shows how much you're paying for each dollar the company earns. Another is the dividend yield, which tells you how much return you're getting through dividends. Why should you care? These tools help you make informed decisions. For instance, if an index like the S&P 500 is rising, it's a sign the overall market is strong. If a stock has a low PE ratio, it might be undervalued, a potential opportunity. Mastering these indicators can take your investing skills to the next level. Keep watching to learn more about navigating the stock market.